There is a truth that most people spend their entire lives avoiding, not because it is hidden, not because it is complicated, but because it is uncomfortable in a way that cuts directly to the center of how we have been taught to live, what we have been told to live, and what we have silently accepted as the ceiling of our own potential. The truth is this: most people are not poor because they lack opportunity. They are not financially struggling because the world has been unfair to them, though sometimes it has. They are not stuck because they are unintelligent or lazy or undeserving. Most people are financially stuck because of the way they think, not what they know, not what they earn, how they think. And more specifically, they are stuck because somewhere along the way, without ever being asked to sign anything, without ever consciously agreeing to the terms, they adopted a mindset that was designed not to make them wealthy, but to make them useful. Useful to systems, useful to institutions, useful to the ambitions of others. They adopted what can only be called the employee mindset. And if you are watching this right now, there is a reasonable chance that this mindset has been shaping your financial decisions, your relationship with money, your tolerance for risk, and your vision of what is possible for you without you ever realizing it. By the end of this video, that will change, not because you will have learned some secret formula, not because you will have discovered a shortcut that the wealthy have been hiding, but because you will see clearly and honestly the difference between how the financially free think and how the financially trapped think. And once you see it, you cannot unsee it. This is not a video about getting rich quickly. There is no such thing as getting rich quickly in any sustainable, meaningful sense. This is a video about thinking differently, permanently, about understanding a philosophy of wealth that has been proven, tested, and validated across decades by one of the most studied investors in human history. So let us begin, not with excitement, but with honesty. Somewhere right now, there is a person sitting at a desk. They are educated, they are competent, they work hard, they arrive on time, they do what is asked of them, sometimes more. They have been doing this for years, perhaps decades. And at the end of every month, after their salary arrives, and their bills are paid and their obligations are met, there is very little left. Sometimes nothing, sometimes less than nothing. This person is not a failure. By most societal definitions, they are a success. They have a job, they have stability, they have a life that looks from the outside like things are working, but inside there is a quiet and persistent anxiety, a sense that they are always one unexpected bill away from crisis, a sense that the future is not something they are building, but something that is happening to them, a sense that no matter how hard they work, the finish line keeps moving. This is the employee mindset in its most raw and honest form. And before we go further, it is important to say clearly, there is nothing wrong with being an employee. Employment is honorable. Work is honorable. The vast majority of people who have ever lived have earned their living through employment, and the world depends on that. But there is a profound difference between being an employee and thinking like one, between having a job and organizing your entire financial existence around the logic of a job, between trading time for money as a practical reality and believing deep down that trading time for money is the only way money works. The employee mindset is not about employment. It is about a belief system, a set of unconscious assumptions about money, risk, time, and value that most people absorb before they are old enough to question them. It sounds like this: work hard and you will be rewarded. Save what is left after spending. Security comes from a steady paycheck. Investing is for people with extra money. The stock market is gambling. Wealth is something that happens to lucky people or dishonest ones. These beliefs feel like common sense because they are common, because everyone around you holds them, because the school system reinforced them, because the culture rewards compliance with stability and punishes ambition with uncertainty. But common is not the same as correct, and stability in the financial sense is not the same as freedom. Let us talk about why people stay stuck. Not in a condescending way, but in an honest, psychological, deeply human way. The first reason is emotional investing. Most people do not make financial decisions based on logic. They make them based on fear and excitement. When markets are rising and everyone is talking about opportunity, they buy because the emotion of the moment tells them that this is safe, that this is what smart people are doing. When markets fall and fear fills the room, they sell, because the emotion of the moment tells them that danger is near and retreat is wisdom. This pattern, buying high out of excitement and selling low out of fear, is one of the most reliable ways to destroy wealth over time, and yet it is almost universal among people who operate from the employee mindset. Why? Because the employee mindset was trained by a world of immediate feedback. You work, you get paid, you do well, you get a raise. The relationship between effort and reward is short, direct, and emotionally satisfying. When you put money into something and do not see an immediate return, the emotional system that was built by years of employment logic begins to panic. It begins to ask, why is this not working yet? Should I cut my losses? Is this a mistake? And so people abandon sound financial decisions, not because those decisions were wrong, but because they required patience that the emotional brain was never trained to provide. The second reason people stay stuck is impatience dressed as urgency. There is a pervasive belief in modern culture that speed equals intelligence, that the faster you can accumulate, the smarter you must be, that waiting is for people who do not have better options. This belief is not just wrong. It is catastrophically expensive. The most powerful force in wealth building is not income. It is not luck. It is not even skill. It is time, and specifically, it is the interaction between time and compounding returns. When you understand compounding at a deep level, when you feel it in your bones rather than simply knowing it as a fact, you begin to see patience not as passive waiting, but as aggressive strategy. You begin to understand that every year you stay invested, every year you resist the urge to pull out, every year you allow your returns to generate their own returns. You are doing something profound. You are letting time work for you instead of against you. But the employee mindset is allergic to this kind of patience because it was taught to expect payment now, to expect recognition now, to measure progress in days and weeks and months, not in years and decades. The third reason people stay stuck is something called lifestyle inflation. This is perhaps the most insidious trap in the financial landscape because it feels like reward. It feels like progress. It feels like you are doing well. Here is how it works. As your income grows, your spending grows with it. You earn more, so you upgrade your car. You get a promotion, so you move to a bigger apartment. You get a bonus, so you take the vacation you have been postponing. You adopt habits and standards of living that match your new income, which means that no matter how much more you earn, the gap between what you earn and what you keep remains roughly the same. You are on a treadmill that gets faster but never takes you anywhere. The wealthy understand something that most people never learn. The gap between income and spending is not just a number, it is the foundation of everything. It is the soil in which wealth is grown. Without that gap, there is nothing to invest. Without that gap, compounding has no raw material to work with. Without that gap, time works against you rather than for you. The employee mindset tells you that you deserve the reward of spending more as you earn more. And in a shallow sense, that is true. You do deserve comfort. You do deserve to enjoy the fruits of your labor. But the investor mindset asks a deeper question. What is the cost of spending that money now versus allowing it to grow for the next 20 years? And when you do that calculation, honestly, when you sit with the real numbers and the real time horizons, the answer is almost always sobering. The fourth reason people stay stuck is short-term thinking. The employee mindset was built for a world of short-term contracts. Annual performance reviews, monthly budgets, weekly goals. It is deeply structurally oriented toward the near future. And this orientation makes people terrible investors because wealth, real wealth, is built over long stretches of time. It requires decisions that make no sense in the short term. It requires holding positions when everything inside you is screaming to sell. It requires patience with businesses and assets that are undervalued now but will be recognized later. It requires a time horizon that extends far beyond the next quarter, the next year, even the next decade. Most people cannot think that way, not because they are incapable of it, but because they have never been trained to do it and never had reason to. Warren Buffett did not become one of the most successful investors in history because he had information that others lacked. He did not have a secret formula or privileged access to data that gave him an unfair advantage. He had something more powerful and more rare, a philosophy, a deeply held, consistently applied set of principles about how value is created, how markets behave, and how time interacts with both. And central to that philosophy is an idea that sounds simple but takes years to fully absorb. The idea is this: do not think like a trader, Think like an owner. When you buy a share of a company, you are not buying a ticker symbol. You are not buying a piece of paper. You are not placing a bet on which direction a number will move. You are buying a piece of a real business, a business with employees and customers and products and competitive advantages and cash flows in the future. And if that business is genuinely good, if it has durable advantages, if it is run by honest and competent people, if it generates real earnings that compound over time, then the intelligent thing to do is to own it for as long as those qualities persist, not to watch it, not to trade it, to own it. This is the ownership mindset, and it is the direct opposite of the employee mindset. The employee mindset asks, what will I get paid for this? The ownership mindset asks, what is this worth and what will it be worth in the future? The employee mindset is transactional. The ownership mindset is generational. The ownership mindset is generational. The ownership mindset buys in a downturn. The ownership mindset buys in a downturn because it understands that the value of a great bus does not disappear because its stock price fell on a bad day in the broader market. Buffett's philosophy, which he inherited and refined from his mentor Benjamin Graham, is built on a concept called intrinsic value, the idea that every business has a true underlying worth that may or may not be reflected in its current market price, and that the intelligent investor's job is not to predict where prices will go, but to find situations where prices significantly below value, buy, and then wait. Wait for the market to recognize what you already know. This requires extraordinary patience. It requires the ability to sit with an investment that the world is currently undervaluing or even actively scorning, and to hold your conviction without being swept away by the emotional noise of the crowd. It requires, in short, an escape from the employee mindset at the deepest possible level. Let us now go deeper into the lessons that this philosophy contains, not as bullet points or quick tips, but as ideas that deserve to be genuinely understood. The first lesson is about the price of certainty. Most people who operate from the employee mindset have a nearly pathological need for certainty. They want to know that their paycheck is coming. They want to know that their job is secure. They want to know that the investment they make will return a profit. They want guarantees. And this need for certainty costs them enormously, because the best opportunities in financial markets, in business, in life, almost never come with guarantees. They come with uncertainty, with ambiguity, with a period of time where things look uncomfortable and the crowd is moving in the opposite direction. Think about what it means to buy something when everyone else is selling. The crowd is panicking. The news is terrible. The short-term outlook is frightening. And yet, if you have done the fundamental analysis, if you understand the business, if you believe in its long-term value, this is often exactly the moment to act, not because you are certain of what will happen next month, but because you are confident about what will happen over the next decade. There is a profound difference between certainty and conviction. Certainty is for people who only act when risk has been eliminated. Conviction is for people who have done the work, understood the fundamentals, and are willing to act in the presence of uncertainty because the long-term math is on their side. The employee mindset demands certainty before acting. The investor mindset builds conviction and acts anyway. This is not recklessness. It is the opposite of recklessness. It is the disciplined analytical recognition that uncertainty is not the same as danger, and that the price of avoiding all uncertainty is the permanent forfeiture of the best financial opportunities. The second lesson is about the difference between price and value. These two words are often treated as synonyms. They are not. They are fundamentally different things, and the confusion between them is responsible for an enormous amount of financial destruction. Price is what the market says something is worth at a given moment. It is influenced by sentiment, news cycles, fear, greed, momentum, and 1,000 other factors that have nothing to do with the underlying reality of what you are purchasing. Value is what something is actually worth, determined by its fundamentals, its earnings power, its competitive position, its management quality, its capacity to generate cash over time. In the short term, price and value can diverge dramatically. A wonderful business can be priced as if it were worthless because of a bad quarter or a temporary crisis or a wave of market panic, and a mediocre business can be priced as if it were exceptional because OSXO, hype and excitement and momentum. The investor who understands this distinction has a profound advantage because they are not trying to predict what the crowd will do tomorrow. They are trying to identify the gap between price and value and position themselves to benefit when that gap closes. Buffett's philosophy has always centered on this idea, not on trying to predict market movements, not on trying to time cycles, but on finding situations where the price significantly underestimates the value, buying with conviction, and then waiting. The market is not always efficient. There are moments, particularly in periods of widespread fear or confusion, when prices become disconnected from reality in ways that offer extraordinary opportunity to the patient investor. But you have to be able to see clearly when everyone around you is panicking. You have to be able to hold your analytical judgment when the emotional pressure to join the crowd is immense. You have to have escaped the employee mindset deeply enough that market noise cannot shake your conviction. The third lesson is about the compounding of character alongside the compounding of capital. This is something that most financial discussions miss entirely. We talk about compound interest as a mathematical phenomenon, and it is. But there is another dimension of compounding that is equally important and almost never discussed. Your habits compound. Your discipline compounds. Your patience compounds. Your capacity to think rationally under pressure compounds. Every time you choose the long term over the short term, you strengthen the neural pathway that makes that choice easier next time. Every time you resist the urge to sell in a panic, you build the emotional resilience that protects you in the next downturn. Every time you delay a gratuitous purchase to invest instead, you deepen the identity of someone who acts like an owner rather than a consumer. Character is compounding capital, and this is why the wealthiest, most financially free people are not just good at numbers. They have cultivated over years and decades a set of psychological strengths that allow them to consistently make decisions that the employee mindset cannot make. They have delayed gratification so many times that it has become natural. They have held through volatility so many times that it has become expected rather than terrifying. They have thought in decades so consistently that short-term noise has become nearly irrelevant to their emotional state. This is not a personality type you are born with. It is a set of skills that you build through deliberate practice, through conscious commitment to a philosophy, through the willingness to be uncomfortable in the short term in service of something larger. The fourth lesson is about the cost of passivity. There is a version of the employee mindset that does not feel like the employee mindset. It feels like prudence, like responsibility, like playing it safe. It sounds like this: I will start investing when I have more money. I will think about my financial future when things stabilize. I am not knowledgeable enough to invest yet. I do not want to make a mistake. These thoughts feel reasonable. They feel cautious in a good way, but they are deeply, measurably expensive. Every year you delayed building an investment portfolio is a year you cannot recover. Not because of lost returns in that specific year, which are significant, but because of the lost compounding effect of all the years that follow. Time in the market is not just one factor among many. It is the dominant factor. It overwhelms the significance of which specific assets you choose to a degree that most people never appreciate until it is too late. The most expensive mistake in wealth building is not investing in the wrong thing. It is waiting too long to invest in anything. Passivity is not neutrality. Passivity is a decision to let inflation erode your savings, a decision to let time pass without putting it to work, a decision to remain on the treadmill of earning and spending without ever building the machinery of compounding returns. Buffett has spoken in various interviews and shareholder letters about the concept of beginning early, not beginning with a lot, just beginning. The magic is not in the size of the initial investment. It is in the time that investment has to grow, and to grow the growth, and to grow that growth in turn. The fifth lesson is about the nature of real risk. The employee mindset has a deeply mistaken understanding of risk. It believes that risk is volatility, that watching your portfolio drop 20% is dangerous, that selling at a loss is something to be avoided at all costs, even if avoiding it means holding indefinitely to eventually recover. More importantly, it believes that not investing, keeping money in a savings account, or simply holding cash is safe. This is one of the most consequential financial misunderstandings a person can hold. Real risk is not volatility. Real risk is the permanent loss of capital. And more broadly, real risk is the failure to build sufficient wealth to maintain your financial freedom and security over a lifetime. Inflation, which is the slow and steady erosion of purchasing power, is one of the most dangerous forces in the financial universe, and it disproportionately punishes people who hold cash. Every year that money sits idle, not growing, not compounding, it is becoming worth less. Not dramatically, but steadily, reliably, inevitably. The investor mindset understands that doing nothing is not safe. It is a choice with consequences, just like every other financial choice, and those consequences, compounded over decades, can be ruinous. Meanwhile, the short-term volatility that terrifies the employee mindset, the market drops and recoveries that look so frightening on a chart in the moment, these are not risk in any meaningful long-term sense. They are noise. They are the market's natural breathing pattern. And for the long-term investor with sound fundamentals and strong conviction, they are often opportunities rather than threats. This reframing from fearing volatility to understanding real risk is one of the most liberating shifts a financial mind can make. Now let us talk about transformation, because philosophy without application is merely interesting, and interesting is not enough. Let us imagine someone who begins to genuinely absorb these ideas, not just intellectually, but practically. Someone who decides deliberately and consciously to escape the employee mindset. In the first year, very little appears to change. They are still working the same job. They are still living in the same apartment, but something has shifted internally. They have created a gap between their income and their spending. They have begun investing consistently, not recklessly, not with money they cannot afford, but steadily, with discipline. They are learning. They are reading. They are beginning to see businesses the way an owner sees them rather than the way a consumer or an employee sees them. They are uncomfortable. The delay of gratification is real. Their colleagues are upgrading their lives, and they are not. There is social pressure, quiet but persistent, to spend more, to display more, to consume more. They hold steady. In years 3 and 4, something begins to happen that is difficult to explain. Until you experience it, the money starts to feel different. Not because there is so much more of it, though there is some more of it, but because, say it is working, because there is a parallel life happening in the background of their daily existence. A quiet, compounding, patient accumulation of value that does not require their time to grow. They begin to understand viscerally rather than just intellectually what it means to have money work for you. They begin to feel the difference between owning assets and merely earning income. The anxiety that used to visit them at the end of every month begins to diminish, not because they are rich, but because the direction is clear, because the philosophy is working. By year 7 or 8, the gap has widened considerably, not because they got lucky, not because the market perfectly cooperated, but because they have been consistently, patiently, intelligently putting time to work on their behalf, because they have resisted the employee mindset in its many disguises, because they have held through downturns that would have broken a less philosophically grounded investor, and they begin to notice something remarkable. The options available to them have changed. Not in a dramatic overnight way, but in a quiet, accumulating way. They have choices that they did not have before. Choices about time, about work, about how they spend their energy, about what projects they take on and which ones they decline. This is what financial independence actually looks like. Not a single dramatic moment, but a slow and steady expansion of freedom, a growing distance between where you are and the financial edge that used to define the boundaries of your life. By year 10, the transformation is deep and undeniable. The compounding is real and visible. The philosophy has been tested and validated not just in theory, but in lived experience. The person who once lived anxiously inside the employee mindset now inhabits a fundamentally different relationship with money, time, and possibility. They did not win the lottery. They did not have some privileged advantage or inherited wealth. They changed how they thought, and they applied that changed thinking consistently over time. This is the promise of the investor mindset. Not quick wealth, not guaranteed outcomes, but a fundamentally better set of odds, a fundamentally more intelligent relationship with the most powerful forces in wealth building: time, compounding, patience, and discipline. Let us be honest about what this requires. It requires sitting with discomfort. There will be periods where the market moves against you and everything inside you screams to do something, to act, to respond. The investor mindset requires the capacity to recognize that noise as not signal, that short-term movement is not long-term direction, that the appropriate response to a great business temporarily trading at a lower price is not fear, but curiosity about whether this is an opportunity. It requires resisting social pressure. In a consumer culture that celebrates spending as identity, choosing to invest in delayed gratification is a quietly countercultural act. People around you will not always understand it. Some will misinterpret your discipline as deprivation, your patience as passivity, your long-term orientation as a failure to enjoy the present. You will need to be secure enough in your philosophy that external validation is not the measure of whether you are on the right path. It requires continuous learning. The investor mindset is not a fixed state you achieve and then maintain passively. It is an ongoing practice. It requires reading, thinking, updating your understanding as new information arrives while not being swept away by every new development. It requires the ability to hold convictions firmly while remaining genuinely open to being wrong, and it requires time, not as a sacrifice, but as a strategy. The willingness to extend your time horizon beyond where most people dare to look is not a limitation. It is a profound advantage because most of the competition in financial markets and in life is focused on the next quarter, the next month, the next week. The investor who is thinking in decades is playing a fundamentally different game than everyone else. And that different game comes with fundamentally different outcomes. There is something else worth saying, something about the relationship between financial philosophy and the quality of your life more broadly. The principles embedded in the ownership mindset, patience, long-term thinking, intrinsic value, over-perceived value, the compounding of small, consistent actions, do not apply only to investing. They apply to careers, to relationships, to learning, to craft, to every domain of human endeavor where excellence is built over time rather than purchased in a moment. When you begin to think like an owner of your financial future, you begin to think like an owner of your life. You begin to ask different questions. Not what will this give me right now, but what will this become if I tend to it with discipline and care? Not how do I escape this discomfort today, but what discomfort am I willing to accept in service of a future I genuinely want? This is the deepest escape from the employee mindset, not just the financial one, but the existential one, the shift from living as someone to whom things happen, who is subject to the decisions of employers and markets and circumstance, to living as someone who is building something, who has a philosophy, who thinks in decades, who understands that the choices made today are seeds being planted in soil that will take time to bear fruit. The wealthiest people in any real sense, not just financially, but in terms of freedom, meaning an agency, are almost universally people who made this shift, who stopped thinking of themselves as participants in someone else's plan and started thinking of themselves as architects of their own. And it almost never happened overnight. It happened through the patient, deliberate, sometimes lonely application of a philosophy that most people around them did not share and could not quite understand. Let us come back to the person sitting at the desk, the educated C, competent, hardworking person who arrives on time and does what is asked and earns a salary that, despite being substantial in absolute terms, leaves them feeling somehow trapped, somehow anxious, somehow aware that the life they are living is not entirely their own. That person has a choice, not a dramatic choice, not a cinematic moment of decision, not a cinematic moment of decision, a quiet, private, deeply personal choice about how they are going to think about money, time, and their own potential from this day forward. They can continue operating from the employee mindset, and this is a legitimate choice. It offers the comfort of the familiar, the security of known patterns, the ease of not having to challenge assumptions that took a lifetime to accumulate, or they can begin the slow, unglamorous, profoundly rewarding work of escaping that mindset. They can start reading about how real businesses create real value. They can start investing even modestly with consistency rather than brilliance as the goal. They can start widening the gap between income and spending, not through misery and deprivation, but through conscious choice and long-term clarity. They can start thinking in years and decades rather than days and months. They can begin to shift their identity from someone who earns money to someone who earns money to someone who builds wealth, from someone who spends time to someone who invests time, from someone who is employed by the present to someone who is employed by the future. And they can be patient, because patience in a world of instant gratification is not weakness. It is one of the rarest and most powerful financial assets a human being can possess. The philosophy of Warren Buffett, stripped to its most essential core, is not about stocks. It is not about reading financial statements or understanding the difference between bonds and equities or knowing which sectors perform well in which economic cycles. At its core, it is about something simpler and more profound than any of that. It is about the relationship between knowledge and time, about the understanding that real knowledge about businesses, about human nature, about the way markets actually work over long periods is the most durable competitive advantage available to any investor. It is about the recognition that the market is not always right, that prices are not always a true reflection of value, and that the investor who can clearly see the difference and wait patiently for the market to catch up to reality will, over time, accumulate extraordinary wealth. And it is about the discipline to remain rational when everyone around you is being emotional, to remain long-term when everyone around you is obsessing over the short term, to remain focused on value when everyone around you is chasing price. This is not a personality trait. It is a practice, a daily, deliberate, ongoing practice of thinking better about money, time, and what you are actually trying to build with your one financial life. If you have made it to this point in the video, something in this philosophy resonated with you. Something in this message found a place to land. The question now is what you do with that resonance, because resonance without action is just entertainment. And the goal of this video is not to entertain. It is to shift something in how you think, permanently and productively. So here is what we ask of you, not as a call to excitement or urgency, but as a call to excitement or urgency, but as a call idea from this video, just one. The gap between price and value, the cost of passivity, the compounding of character, the price of certainty, the true nature of risk. Whatever landed most powerfully for you, whatever cracked something open in your thinking, take it and sit with it. Not for 5 minutes, for days. Let it interact with your actual financial life. Let it make you uncomfortable in the productive way. Let it illuminate the places where the employee mindset is still running your decisions without your conscious permission. And then begin. Not perfectly, not dramatically, not with all the answers figured out. Just begin. The most powerful financial journey you will ever take does not start with a large amount of capital. It does not start with perfect market conditions or a brilliant insight or an extraordinary opportunity. It starts with a decision about how you are going to think. That decision is available to you right now, in this moment, in the quiet, after the noise of this video fades. If this perspective is one you want to return to, if you want to continue exploring the philosophy of wealth, discipline, and long-term thinking, the subscribe button is there, not for empty reasons, not for vanity metrics, but because this is the kind of thinking that rewards repeated exposure. That opens deeper and deeper the more you sit with it, come back, think more, build something. Worth building. The employee mindset served a purpose. It got you here, but where you are going requires something different. Something patient, something rational, something long. Begin now, think like an owner, and never look back.